I'd like to ask members of the panel what they think of CIMIC's offer for UGL. I noted that one of the board members of UGL was against it, but the majority were for it. And interestingly enough, the board's on 3 strikes as far as their remuneration is concerned.
I think I'll give that one to Mitch.
Well, I'll do it right back. I'm afraid it's not a situation I'm watching at all. I can't really comment at all. Right. If any of us were watching it, I think it would be Gaurav, and he's not here. So it's not stocks I look at, I'm afraid.
Okay. Thank you. Okay, thanks a lot.
There's a...
Thanks very much, guys. When you were talking about diversification and rebalancing earlier, as far as your own portfolios, these income and growth portfolios, do you have a fixed frequency with which you approach that process of looking, rethinking, redoing, or is it dynamic?
It's dynamic. I mean, it's all the time. Yeah. So we have quarterly investment committee meetings, which we sit down and have a really good look, including Paul Clitheroe and Alistair Davidson, who's somewhere I think at the back, and Ron, in fact. So I mean that's the more disciplined cycle, I suppose. But I'm looking at both portfolios daily, really. But as I think was mentioned earlier, you don't want to be looking every minute. I tend to. I tend to look at my portfolio more often than I should, because you're in danger of getting into that short-term mindset, and it's absolutely crucial. You can let yourself look at the portfolio as long as you make sure you keep your mind fully on the long term, I think.
I think the other interesting thing as well is what a lot of our members probably don't know is our Dragon's Den on a Monday morning. I'll let James tell you about Dragon's Den.
Well, it's not always a Monday, but it's, a new stock that we're looking at needs to go through a Dragon's Den before we'll recommend it, and before it therefore goes in the portfolios. But existing stocks that we cover that have price guides, that's a matter of assessing the value and then making a recommendation, and then perhaps buying them for the portfolios if they're deemed suitable, if it's deemed that they'll improve the value and maintain the right balance.
Could I just add a few comments to that? I don't know whether there's one particular frequency where you need to look at your portfolio and say, should I change anything? I think in some ways the mindset is just as important, and I think many members over the years have had such a wonderful time and a wonderful experience in investing in Australia's largest banks that shifts you into a frame of mind where it becomes difficult to ask yourself whether you've got too many banks in your portfolio. And that performance over the long term stops you from really asking that question. So I think the mindset is important, the way that you approach it, the ability to dissociate yourself from the performance and ask about the risks is an important thing. And the second point would be that whilst there isn't a particular frequency that I suggest you look at your portfolios, I do think that by and large we do too little of it. So if there's one thing I would say is do it more often.
I had a couple of questions. One was, I noticed in the model portfolio slides, it mentioned the alternatives asset class, but I wasn't sure how much they actually were included in the model portfolios. I wondered if you had any thoughts about their accessibility and the use of them in a portfolio. And the second question had to do with LICs. You mentioned ETFs as an investment vehicle, and was wondering about any thoughts about use of LICs.
I think a lot about them, actually. I used to write about them quite frequently. I still keep an eye on them very regularly, and I think they certainly do have a place in people's portfolios. You certainly need to be aware of the strategy that the managers are using. They're certainly not all created equal, and So you really need to look through and see how much, say, cash they're holding as well, because that'll affect your overall asset allocation. If you look at something like AFIC, you're looking at 3, 4, 5% cash. 6% is overweight in cash for them. They think that's a lot. But you look at something like the Wilson Asset Management ones, and they're quite regularly happy to sit in 30% plus cash. So just be wary of what you're investing in, especially when it comes to if you're actually specifically investing in this particular LIC for your exposure to Australian equities. What you get in an AFIC compared to what you get in a Cadence Capital, for example, is completely different. So that you just need to keep that in mind. But yes, I do definitely think they can play a part. But then, of course, it comes down to yourself to be able to manage the underlying exposures and to,
Some of them are a little bit illiquid as well, aren't they? Some of the smaller ones, some of the ones that perhaps show a bit of value, one of the ones with the PM Capital ones, they're relatively illiquid, so difficult to buy in any great volume.
Yeah, they can be very difficult to buy. So
and that means you've got to watch the discount as well, of course. So it becomes all a bit more technical. You almost need to start treating them like a value proposition rather than
But
fun.
of course, if you do get it right, you can get the benefit of that value proposition where you're buying at a discount to NTA and then seeing that gap close. And of course, you have to be seeing the performance going in the right direction and the communication to shareholders going in the right direction to close that gap, and then you can see a nice little kick.
You've asked the right person for LICs, by the way, because Mitch has been covering them for Eureka Report for a while.
Yeah. And my question on alternatives as part of the overall portfolio?
So alternatives are hard. We don't carry any alternatives in our model portfolios currently, and that's probably because the ETF market, which we use majoritarily for building those portfolios, we don't really have much. ETFs is actually quite a new product in Australia. I mean, everybody thinks it's been around for decades, but I mean, the first ETF of gold was only, several years back. And now we have about 150 ETFs on the Australian stock market. But a lot of those ETFs are still your big index trackers. They're not, if you go over to the US and the UK, you have an ETF for pretty much anything you want. In Australia, we don't have that yet. And so over time, we'll start introducing ETFs. The only thing we really could put into those portfolios is something like gold, which there's some ETFs on. But we've stayed away from that at the moment, and we've just kept with the other asset classes. And even if we were to put alternatives in, it would be a very, very small percentage.
I think you've got to be a bit careful with alternatives as well, because I'm not even sure what they are. Do you know what I mean? People talk about alternatives, and it can that definition can stretch a long way, and you can start talking about assets that aren't really viable long-term investments. I don't know, art and things.
I think to combine the two questions potentially, though, there's a couple of LICs out there. They can give you exposure to alternatives, but you have to be. Take them with a grain of salt and take them at a very, very, very big discount.
Just on the coverage of the listed investment company sector, I'd say that over the past few months, our coverage hasn't been as detailed and as deep as it normally has, but we now have a dedicated analyst called Phil Bish, who's now working on LICs specifically, and you'll be seeing much more coverage of that sector over the coming months.
With Mitchell.
With Mitchell.
Mitch will chime in.
Phil.
Every now and then.
Where do you see the major risks in the world economy in the future?
Now?
They're trying not to think about it.
Yeah, I mean, the major risks are the same as they've always been, I think. It's a combination. I mean, we try to think very long term. So, I'm not really focused on what the risks are over the next year or two. Over the long term, it's a question of getting growth and how that relates to interest rates. I mean, in a sense, the two things cancel out, because if we start, if interest rates go up, then it'll be because we're getting a bit more growth. So, I guess my focus stays on stocks, and I think those factors end up sorting themselves out over the long term.
We concentrate more on diversification rather than, what could happen around the corner. But I mean, I think interest rates are the biggest.
Yeah, interest rates
as a whole is the biggest problem.
Interest rates, if interest rates suddenly rise, long-term interest rates, that's what governs valuations. Long-term interest rates suddenly rise, in fact, as they did yesterday, but equities didn't seem to mind too much. Then, I mean, that itself would have a large impact on the valuation of stocks. But, you know, the reasons they would rise, as I say, is because we're looking at a bit more growth and or possibly inflation. If it's inflation, then the bonds aren't going to do you much help. And if it's the growth, then ultimately that should help equities as a class.
I can add a few more concerns, if you like. Where do you want me to start? I'd say one of the other things, and I think the arrival of Trump sort of accentuates this, but it's not a new thing, and that's the fact that investors generally have been big beneficiaries of globalisation over the past 20 or 30 years. That's probably what's been behind the growth in corporate profits as a percentage of GDP. And that has delivered good returns to investors. And as Jeremy Grantham constantly says, corporate profits as a percentage of GDP are well above the average over the long term right now. So if there's any reversion to the mean, then I think any kind of anti-globalisation forces will probably be behind that. That would be one. The second thing is, I think the political risks are probably slightly bigger now, but they're always there. There are some demographic trends that are difficult to really see in our economies, but in the West, we've got population stagnation. We have immigration here that keeps our population growing, but in many places, especially Western Europe, we don't. And we're likely to have less of that. There are plenty of things to worry about. There are some good things happening too. There's a risk with China, but I think that long term, there's some very, very big benefits to Australia from China's growth. I don't think that industrialisation is in any way going to reverse over the longer term. I think when you look at all of those risks, I don't know whether they actually change what you would do and how you might actually balance your portfolio. They might make some minor differences to it, but the problem is when you talk about this kind of stuff, there's a temptation to act on it. And all of those things that I've just described may or may not have any impact. And to try and forecast what's going to happen and adjust your portfolio accordingly is generally it's a difficult thing to do because often those risks don't eventuate. So I think the best defence to all of those risks is simply to buy cheap stocks.
I think the other point to make is that the biggest risk of all is when no one's worried about anything. You know, that's sort of how it felt in around 2006, 2007.
Yeah, that's
But
right.
if no one's worried about anything, then prices are going to be a bit too high. Because there's always problems. There's always threats. Sometimes we're more aware of them than others, I think.
That doesn't help, but I'm afraid that's all right. Yes, this lady just behind and then this gentleman down here.
Could you just talk a little bit more about the methodology you used to come up with the value?
Oh, don't get him started on that, please.
Read the book.
Yeah, well, the book that's 130 odd pages, I think, on there. Or is it more? I don't know. Anyway, that I suppose is the point. I mean, ultimately, value is defined by a discounted cash flow. You know, a share's value is the discounted value of the net cash that will flow from it over the years. But you get yourself into big trouble very quickly if you start building these huge models. So we don't really use discounted cash valuations per se, but the important thing about it is that it directs your thinking. So by thinking about a discounted cash flow, but by understanding that that's what represents value, it enables you to make sense of the other metrics that are easier to sort of throw around, like the price-earnings ratio, price-to-book ratio, dividend yield. So, you know, by understanding the DCF, you can realise that the price, you know, how a bank relates to its price to book and the return on equity, and how the return on equity, it retains earnings, and those retained earnings throw off cash. And so you can sort of try to make sense of these things in your head. I mean, I suppose every stock is different. So, you know, some stocks, banks, as I say, for example, you might look at the price-to-book ratio, but the price-to-book ratio is going to be no use at all for a stock like SEEK, which hardly has any assets. All its assets are intangible, essentially, and not on its balance sheet. I mean, fundamentally, what we want to see is cash. I mean, because of the DCF. So what we want to see is cash, and we want to see growing cash, and we want to see that cash growing enough to justify the price that we're paying. So I suppose you look at the free cash flow yield and add any growth. That's a very basic way of looking at things. That gives you a sort of expected total return. Yeah, it depends on the soil. And I suppose the other point to make is that how you see those cash flows developing, depends. Over the long term, it tends to depend more on the quality of a business rather than any particular trends we see. We're not trying to sort of second guess trends in, whether people are going to be buying more of this next year or whatever. The market's pretty good at forecasting that sort of thing itself. But I think where the market falls down is it doesn't tend to think about the qualities of a business over the next 10 years, that the things that will stand it in good stead to keep generating cash, to keep its competitive advantage and its ability to make a margin over 10 or 15 years.
Sorry to interrupt. Can I just add something to that? Because I think this is important, an important discussion. We all have a limited time, and if we're running our own portfolios, we have to decide how to spend that time. And for me personally, spending that time calculating the intrinsic value of a stock and trying to buy a dollar coin for 70 cents, for me, is best left with James because and his team, because they've been doing it for a long, long time and they're good at it. And I think that even if you have that information, the hardest thing to do as an investor is to act on it. Because when you buy a dollar's worth of value for 60 or 70 cents, you are going against the crowd. There will be something wrong. There will be concerns, there will be worries, there will be risks when you have to make that decision. And for me, the best way that you can spend your time is to develop those skills to act on that information. That is, I think, the hardest thing for us to do. It's understanding our own psychology and understanding why we don't take decisions when we should, and learning to guard against them and refine your thinking when you're presented with opportunities is a much more profitable use of my time. It might not be for you, but for me personally, that's the best use of my time. And if you think about the GFC and when we were in the teeth of that thing, how hard it was to buy stocks when they were incredibly cheap. And looking back, that's probably one of the best stock buying opportunities we're going to see in our lifetime. How many of you actually went out and said, this is it, this is the moment when I need to act?
I did it a couple of months before.
There's a few hands going up. There's a few hands going up, and those people should be congratulated. But we got a letter from a subscriber. It was a long, long letter. And he'd said, look, I know the philosophy, I know the approach, I know it works. But when it came down to it, I just couldn't do it. And that's the thing that most investors struggle with. So learning how to do it is for me, a better use of your time rather than calculating intrinsic value. Leave that to these guys.
The other point I'd make just quickly about valuation is about margin of safety, which I think is absolutely critical. The phrase gets thrown around probably too much, but Ben Graham and Warren Buffett have both said it's the most important thing, and they're probably right. When you look at a valuation and you look at what you calculate to be an intrinsic value, you're really looking for things that are priced quite a long way below that, So you're trying to give yourself a margin of protection, and that's the degree to which a stock is undervalued, but that also provides you with that protection. So, you're hoping to find situations where, on the face of it, according to the best calculations you can make, the best estimations you can make, understanding the business and all that, the business isn't just a little bit cheap, it's, giving you that margin of safety, which I think protects you and gives you the confidence to ride out some of these. If you're confident in the quality of a business and in your assessment of its value, it's much easier to deal with it halving like South 32.
Okay, so I knew it was a bad idea to ask that question. Thank you very much. Any other questions? This gentleman over here.
Yeah, a question about the rationale for your international equities. Is that driven by the fact that you're trying to get into assets that you can't get into here, or is it driven by the international side of it, which is basically a currency play?
Well, you can talk currency, but I'll talk about so getting access to international equities. I mean, if you look at the Australian market, and I think this is one of those sayings that's been thrown around a lot in the last 2 years as everyone's rolled out an international fund, that the Australian market only makes up 2% of the global market. That's something that every fund manager is saying at the moment because they're all releasing international funds, and it's true. And so you look at the companies that we have here. The Australian market's made up of, a couple of banks, a telco, a couple of miners, and a supermarket, and we just don't have access to, say, a lot of the dynamic companies, etc., that exist internationally. For example, your Googles, your Apples, etc. So it's getting access to those, and yes, getting access to markets that we don't have here to diversify your portfolio.
Can I just butt in for a second there? I mean, I think one of the fundamental points about, in economics is about matching your assets with your liabilities and matching your income with your expenses. And so when you're diversifying, you've got to think about what you're actually trying to achieve. And what you're trying to achieve is that you've got enough spending money for later on. And so what are you going to be spending that money on? You're going to be spending that money on, probably Apple iPhones, or, you'll be buying your fuel, which comes from oil. And so you're better off in Australia for that anyway. But, you're consuming a lot of things which are actually produced overseas. So you're not getting necessarily that much protection against those, you're not matching for those just by investing in the Australian economy. Australian companies do some activity overseas, but if you want to hedge your future expenditure, if you think of it like that, then some international exposure is going to make some sense.
I think you're right though. I mean, it comes back to ease. I mean, if we have a look, last end of 2014, we started to look at covering international stocks in Intelligent Investor. What we realised quite soon was that everybody, whenever you send a survey out to all of our members and say, what do you want? Tick international, they just tick everything. Yeah? And then we did that, but we were very light on. We pride ourselves on having 10 analysts in our Australian equities. We know what we're doing in that marketplace. We only had one in international equities. We thought it was quite thin on the ground. Surveying our clients and talking to them, most people didn't want to go and get a foreign currency, get a foreign bank account, open up a new trading account for international equities and trade them themselves. I mean, it just didn't happen. So ETFs, I think, is one of the major advances in Australian markets to give us really easy access to international equities. But coming back to what we've been speaking about today, we don't have the internal capabilities or knowledge to manage a portfolio of international equities directly. So going to James's sort of slides, we decided to go with the index because for us, we think that that is the best way to do it for you and also for us. But then what we do is we do the tactical asset allocation behind that, the secret sauce of which ETFs to buy, which countries to buy, and we have researches around that, but we stick away from picking individual stocks.
And currency comes into that secret sauce.
And currency comes into that secret sauce. Most of the ETFs on the Australian Stock Exchange, as most of you probably know, are hedged anyway. I mean, there's not too many unhedged ETFs out there, and the majority of ours are all hedged.
James.
I've got several questions. One of them sort of follows on from that, and it's basically how you classify companies which are within the ASX, but a large proportion of whose business is done on an international basis. CSL is the one that obviously comes to mind, but there's quite a range of other ones. And do you consider those as Australian companies or international?
But, I can answer that from our point of view in terms of covering ASX stocks. It's actually a very interesting question because there are some overseas stocks which have no relevance really to Australian investors, which I don't see any purpose in covering because they don't really provide that diversification benefit. So an example of that would be Clydesdale Bank. I mean, we still cover it because it's come away from NAB, so a lot of people hold it, so we're trying to provide a service there. But long term, and Henderson Group would be another one, long term, you know, there's no obvious reason why Australian investors, I think, would want to get involved specifically with those stocks. Although, you know, aside from getting, you know, overall international exposure, there are other stocks which have more of an Australian connection. I suppose CSL has a greater Australian connection, although it gets most of its earnings from overseas.
Computer share.
I mean, I suppose, well, Computer Share also, yeah, ResMed, I mean, there's a few of them, but I mean, I guess secretly as well, we sort of like those businesses a little bit more. But, yeah, there does come a point where you say, well, what's the relevance of this to our audience?
No, I'm just wondering how it feeds into your classification of your portfolio allocations.
Yeah, you're referring to when you say you put it into your portfolio manager and you see your total balance, it'll come up as Australian. We can't go into that granular level of where
what we can do is you can override it.
Yeah.
Yeah,
okay.
but you got to think we you know, it's at the heart of us is a sort of like a digital company. We take data feeds from S&P, Morningstar, CapIQ, you know, ASX, you name it, you know, we pretty much get it. And we have to use the classification of all those securities in some regards for our algorithms to work it out. You know, we don't look through. So A-REITs are very easy for property, hybrids are very easy for fixed interest. The fund managers are very easy because they now give us asset allocation of each of those funds underneath. But for specific stocks, the research team on the Australian Stock Research, they look at that, but the algorithm doesn't. It depends on what the ASX or the GICS code, if you guys know what GICS codes are, it's what the GICS code says it is.
Okay. The other question that I have really deals with your two different families of managed portfolios or funds. Mm-hmm. Am I correct in thinking that the InvestSMART ones are basically portfolios of funds and the intelligent
Correct.
investor ones are basically shares?
So James touched on this a little bit. So
yes.
on the InvestSMART diversified portfolios, there's sort of like three groups nearly. On the InvestSMART diversified portfolios, which is the income, conservative, balanced growth and high growth, they're a basket of ETFs.
Yep.
ETFs or ETFs.
Just ETFs?
They're all ETFs. Yeah.
Oh,
yeah.
Okay.
And we allocate between those ETFs to get our tactical asset allocation and strategic asset allocation for that diversified risk profile. For the sector-specific ones, we also use ETFs. I think it's only fixed interest. We got PIMCO. Yeah. We've got one managed fund in our fixed interest portfolio, and that's just because we couldn't find enough diversification on ETFs in Australia for our fixed interest one.
I see.
And then the Intelligent Investor 2 portfolios are purely direct equities. So that's our passive index funds where we actively tactically allocate, and then James runs the active funds, which is two, the II income and the II growth. And
so the fees seem to be the same for both families of funds.
That's correct. The fees are the same across.
Fees and James would entirely go to the intelligent investor analyst type of thing.
Yeah.
Mentally, and otherwise you'd get some for managing, in inverted commas, the ETFs. Is that how it works?
Yeah, correct.
Okay.
And I mean, I think
Thank you.
in some respects, the II ones are probably, James and the analyst team thinks that they should probably be higher than the actively managed, the passive ones.
I wouldn't say higher.
But okay. So James thinks the other ones should be lower, and we think that over time that'll come down. If you look in the US, and some of the people doing this, I mean, those guys are coming down to 75, 50 basis points. I think there's room to move in Australia, and I think we're in a good position to bring those fees down over time. But there are still lots of costs in Australia dealing with the Morningstars and the ASXs and whoever else that still take their pound of flesh. But I think those fees will come down.
Any other questions, James, at the back? Okay, next.
Yes, hi. Mitchell, thanks very much for the broccoli salad recipe. It's been a big winner in the family.
Well, there's one person.
Yeah, there's one. Yeah. I've got a
this
great
is
story about that recipe.
Tell us later.
This is a question in relation to diversification. Say you've done your health check, and Ron, that's a very good system and feature, thank you. You've realised you're coming to the twilight end of your life and you've got to get into fixed interest. And you look at the yields at the moment and you think, taking what you say, James, that you're paying $1.10 for a 70-cent asset because the yields are so low, you're going to get into a fixed interest fund and there is potential. I don't see a lot of value in there at the moment. How do you respond to that? Are you just saying, well, if you've got to put an allocation to fixed interest, even though they're probably fairly fully priced, would you just do it to diversify, or would you try to be a bit tactical with that? I hope that makes sense, the question.
Yeah. My point on that is, I think what happens when you move from a risk profile over our lives, we move from high growth down to conservative, and we should be doing that over time, and that's what sort of the portfolio manager allows you to, as you've well said, you can change your asset, you can change your risk profile at any time, and it'll recalibrate everything and tell you whether you're underweight or overweight. The big point of it is time horizon, and you're right. You might go, well, if I go to conservative, it tells me I need more fixed interest, and that's only 2.5%, 3%. The problem is you've only got, theoretically, you're only investing for a 3-year or a 4-year time horizon. And so I'd be more worried about not what I'm earning, but what I'm going to lose in that period of time if there was a shock to the marketplace. And I think that's what happened in the GFC. When you lose half your money and you didn't expect to, or you weren't, it's okay to be older and say I'm high growth. We don't care about that. As long as you know what your risks are and what asset classes you're in. That's what the whole tool is for. It's not really to say you're wrong or you're incorrect. We don't care. As long as you know what your risk assets, what your asset mix is compared to the risk profile you're at. And I think it's more about time horizon and worrying about what you're going to lose rather than what you're going to make.
I think one other point is that you can make things a little bit easier on yourself if you think about the income you're getting from the assets rather than the assets themselves. So if you're sitting there, in the twilight days, as you said, what matters to you is the income coming into your account every month. If the capital value is halved, that wouldn't matter so much if the income stayed the same and the yield doubled. And actually, that's not a million miles away from what happened in the GFC. The dividends fell, I think, by 10% for a year or so, didn't they? And then carried on going up over the market.
But you're making the assumption that nobody actually pulled out.
Well, as long as you've got the, well, that's what I'm saying. So if you have the mental
investment temperament.
capacity,
If we look at our 1.5, we had about 1.2 billion in managed funds in 2007, so December 2007, and we watched our members. It went down to about $690 million, and we started seeing in early 2009. So I think the low of the market was around March 2009. We started seeing people starting to pull their money out and go into cash at the exact wrong time, which is very much what Mitch talked about, temperament. It's very easy to say, I'm going to hold my assets, I get the same income, I'm not going to do nothing. But when you see the blood in the streets and the noise in the newspapers and the world's going to end, people went to cash.
Yeah.
And that's what they did.
The funny thing is that cash is then lower returning than the things itself.
I understand people do the wrong things at the wrong time.
Jumping off the wrong train at the wrong
You can help your temperament if you focus on the long road ahead and and that cash flow generation. And I think what I'm saying is that it can help your temperament. It can help you not make those mistakes.
Correct.
Does that help?
We're having
the recipe was good,
We're having our
right?
own Dragon's Den.
You got the recipe.